One of the inescapable realities of being an investor is that some type of fear is always pulling on you, whether that's the fear of loss or the fear of missing out. We discussed this week where the greatest temptation lies today. So it's one of the unfortunate truths that investors were always battling against some type of fear. Volatility, which goes both up and down, is, as they say, the price we have to pay to make money over time in the markets. And one of the things I always want to do within the commentaries written or here within the video is help position you emotionally against what I perceive to be the greatest threat at any one point in time. So what is that today? Well, quite simply, it's FOMO, as the kids say, fear of missing out, chasing. Year end came, you've been chatting with some of your buddies, they're telling you about their Tesla or their Zoom or their whatever company you haven't heard of before and all the miraculous gains that they have. And that's got you wondering, man, should I have a little bit of that Tesla now? Well, again, we're not here to talk about Matt's favorite stock. I say that jokingly, or not. I'm not here to make a call on Tesla. My point is keeping in mind our discipline. And point number one is the unexpected is going to happen. We certainly learned that in spades in 2020, but volatility as it manifests in the market is something that happens with some frequency, and you need to keep that in mind. That one, there's probably going to be a better moment in time coming forward, particularly if you're looking at chasing one of those high flyer stock ideas that your buddy's bragging about. But you also need to just be emotionally ready for it, as again, we've had a pretty nice run here for a while, and those runs inevitably come to an end. In fact, about half of trading days, a third of months, and a quarter of years produce negative returns. Doesn't mean things are broken. That's actually how markets normally function. So again, be mentally and emotionally prepared for that. And hopefully the fact that it comes with such great frequency, again, gives you a little bit of caution, a little bit of humility about trying to chase and deviate from a long-term plan. Point number two is that the hard evidence and the anecdotal evidence is suggesting caution from a number of different perspectives. Number one, cash is on the sidelines is nearing an all-time low. Equities as a percentage of investors' portfolio is nearing an all-time high. The euphoria index at an all-time high, surpassing even 2,000. And almost everything that's really been working over the last 9 months is actually the riskiest, junkiest parts of the market. So if you look at that, has all, again, the telltale signs of a market bubble, not for everything, not all asset classes, not all stocks, but again, a lot of the ones to that anecdotal point that your buddy, your friend, your family, your mechanic are probably telling you about of all the great gains that they made again over the course of the last 9 months. Point number three, even the pros and analysts get it wrong. So there's a great study that came out from McKinsey talking about how overly optimistic a lot of analysts are, usually to the tune of about 10 to 12% of what earnings are actually going to come into, which lo and behold tend to grow over time like the economy. To harken back again to one of my favorite quotes of all time, Benjamin Graham's, I shared last week as well, that yes, in the short term, the market is a voting machine, and so it is privy to emotions and chaos and greed and fear. But over time, economic gravity, market gravity is going to come home to roost. And that's where we want to keep our process centered around. And that's the disciplined approach that we want to maintain. These people, highly educated, highly informed, arguably more than most of our friends and family when it comes to markets. And so again, every time you want to get tempted into that secret process, that secret newsletter or website, keep in mind there are only a few Ray Dalios in the world. Even if they had found the secret process, they'd probably put that into effect like Ray Dalio had and create an epic hedge fund that, last I checked, has that gentleman's net worth at roughly $20 billion. So again, narratives are powerful, stories, emotions, all very compelling. Back it back, think about that truth, and don't let these things bother you any more than someone getting lucky winning the lottery. Last point, to hopefully end it on a high note, is that there is hope. There is attractive things out there. In the written commentary, along with a lot of the charts and graphs and facts that I've been sharing earlier, there's a great chart from JP Morgan where they show right now the historic dispersion in valuations within the S&P 500 is near an all-time high at more than 20 times as opposed to the historic average of 10 times. So what does that mean in short? It means some things are way above their moving averages, way above historical valuations. Well, there are a lot of other things that are missing, haven't kept up, aren't trading at overly priced valuations. These are the parts we want to go into. And while buying low, sell high always sounds easy, again, the tough part is these things that, again, still present some attractive opportunities are the things that no furniture salesmen are posting about on Instagram. They're not the things that you're going to brag about at any cocktail parties yet, but they very well may be in time, but they also present a lot less risk moving forward than things trading at 80, 100 times earnings. Keep focused, keep disciplined. It isn't sexy, it isn't fun, but again, as I close the written commentary this week, when I look back at those investors who have been most successful, those processes that are most repeatable, they aren't fun, exciting, post-worthy type stuff. They're the day-to-day discipline that gets you from point A to point B. And again, they're the things that your financial goals are really made of. Thanks so much.